When liquidity moves faster than capital can react, risk doesn't wait, it compounds. Across digital asset markets, liquidity migration is accelerating, reshaping execution risk, institutional monitoring, and portfolio stability. Price may be visible, but liquidity often isn't. And when it shifts between exchanges, chains, and protocols, stability can disappear before most participants even notice. Liquidity today doesn't simply enter or exit markets, it relocates. Centralized exchanges, decentralized platforms, layer 2 networks, and cross-chain bridges are all competing for the same pools of capital. When those pools move, execution quality suffers, slippage increases, spreads widen, and exits become harder under pressure. For institutional allocators, this isn't theoretical. It directly impacts fill quality and risk exposure. That's why liquidity monitoring is no longer optional, it's foundational. Liquidity migration follows incentives, infrastructure, and perceived safety. Stablecoin flows between ecosystems like Ethereum and Solana, yield shifts in DeFi protocols, exchange incentives, regulatory changes, and even latency advantages all influence where capital moves. And it can move fast, within hours, sometimes minutes. At the same time, the expansion of digital infrastructure has fragmented liquidity. It now exists across order books, automated market makers, cross-chain pools, and derivatives platforms, each operating under different rules. This creates execution gaps where one venue no longer reflects the broader market reality. Institutions don't rely on surface-level metrics. They track signals like stablecoin flows, total value locked in DeFi, funding rate shifts, arbitrage spreads, and bridge activity. These indicators reveal where liquidity is heading before execution conditions deteriorate. Because liquidity doesn't disappear, it relocates first. During stress events, these shifts become more visible. Spreads widen, execution slows, and slippage increases. Then, as volatility spikes or risks emerge, like stablecoin instability or protocol failures, capital moves rapidly to safer venues, leaving gaps behind. DeFi has amplified this speed. While it enables efficient capital deployment, it also creates interconnected systems where liquidity shocks can cascade. Shared collateral and composability mean one shift can impact multiple protocols at once. This is why liquidity is no longer just a trading variable, it's a core risk signal. At Kenson Investments, liquidity is treated as a structural component of portfolio management. The focus is not on reacting to price, but on identifying where liquidity is forming, where it's thinning, and how that affects execution conditions. Because in digital markets, diversification alone isn't enough. If assets depend on the same liquidity sources, risk becomes interconnected. True portfolio resilience requires understanding infrastructure, execution pathways, and capital flows. The market is evolving. Liquidity is becoming more mobile, more fragmented, and more sensitive to incentives. The question is, are you tracking it? If you want a framework built around liquidity discipline, not just price reaction, connect with Kenson Investments today and discover how to navigate digital asset markets with greater clarity and control. Visit kensoninvestments.com